Alright, the promised video on cost flows and manufacturing overhead and how we deal with these manufacturing accounts on our balance sheet and income statement. So let's first talk about the accounts and the process that we go through, okay? And then we'll talk about why we're doing what we're doing, okay? So we start with our raw materials account. Like I said, we can consider that just a separate room that contains all of our raw materials. In this example, let's say we're manufacturing cars, okay? So all of our raw materials will have rubber and tires and metal and all the things, the parts we need to put together cars, right? You can think of this as a separate room. Now, each of these accounts, these three accounts, are all inventory accounts. So you can call it raw materials inventory, work in process inventory, and finished goods inventory, right? So they all increase with debits and decrease with credits. Those three, okay? Cost of goods sold account, you know what that is. That's an expense, so it's on the income statement. But because it's an expense, it goes up with a debit and down with a credit, okay? Manufacturing overhead isn't really a type of account. It is an account, but we don't classify it as a certain type because we end up just closing it out. It's merely, what you can think of this as, is just a holding account, okay? It's something that we use to keep track of our allocations of our indirect costs, okay? But we'll get to that a little bit more later. Just remember, we start with these raw materials where we have all of the things that we need to produce something. Once we take those things out of raw materials and put them onto our WIP account, you can think of your WIP as this manufacturing belt, right? It's moving, and there's car number 1 and car number 2 and car number 3, right? That's moving along. And once we finally complete these cars, where do they move to? Well, they move into finished goods. And you can think of this as your display room, right? It's out on your car lot and it's ready to sell. These are finished, ready to go. Now remember, once we sell these finished goods, you guys know this journal entry. When we sold inventory before, what did we do? Well, let's say we sold it on account. We would debit AR and credit revenue, right? There's 2 journal entries. That's the happy one. The sad journal entry is debit COGS and credit inventory, right? Well, you guys, that's exactly what we're going to do here. Whenever we finish goods, we're going to credit finished goods inventory, take it out of our finished goods because it's not available for sale anymore, and record that as cost of goods sold, right? That's this journal entry right here. Okay, so that's what we're doing. Whenever we sell these finished goods, they're going to move into cost of goods sold. Okay, so you can just remember that's the flow. Okay, as we go through these top accounts, that's the flow. Now, this is where our manufacturing overhead account comes in. And in order to understand why we're doing this first, you need to understand the different types of costs that exist in a manufacturing facility, right? So, if we were to talk about the difference between period and product costs, we went over this in class, but as a refresher, okay, period costs are anything happening in an office, and product costs is anything related to the factory. Okay, that's how you can make that distinction. This whole discussion is only dealing with product costs, okay? We're not dealing with period costs at all because period costs go directly to the income statement. They're just expense. For example, if we're paying for an advertisement campaign, right? We would debit advertising expense and credit cash for however much is. Does that make sense? Now, factory costs or product costs are broken down into 2 different categories, right? There's direct and indirect. Direct go directly into WIP, meaning these are things that you can directly see building the product. Things that, like the metal going onto the manufacturing belt, that would be direct materials, right? There's also people working on the machine, on each of the cars, right? That is direct labor. That's directly, you can see it actually touching, actually producing the product, okay? Those are the only two direct things you're going to see in this class: direct materials, direct labor, okay? And those, like I said, go directly into WIP. So those are my first two things in WIP. And there's only going to be one more thing that we're going to get to. Now, indirect, first go into manufacturing overhead, and then they get applied into WIP. To WIP. Okay? So, essentially what happens here is we have other costs besides direct materials and direct labor, right? So there are other people in the factory that aren't actually building and touching the product. What would be an example of that? There would be a supervisor, right, standing on the line that's not actually building the product, but he's a cost to us. So he's not a direct cost, but he is in the factory, so he's still product costs. There's people like maintenance workers in the factory. Those are additional indirect labor, right? And then we have expenses like the utility bill and the insurance bill, right? All those are related to the factory. There's depreciation on the machinery, right? All of these relating to the factory but aren't direct costs, okay? All of these, when we get these bills coming in, these actual numbers that we know for sure how much they are, we are going to record them here on this side. So I'm going to put actual bills. Okay, things like for indirect materials, indirect labor, and any other indirect costs that are factory costs. Okay, actual. Okay, but before, some of these bills aren't going to come at the beginning of the year, right? We're going to have property tax expense, we're going to have utilities expense, we're going to have lots of things that we're not going to know the actual number until the very end of the year, right? But we're selling cars all throughout the year, so we need to have an estimate of what these costs will be in order to accurately distribute these costs amongst all of these cars, right? The example in class I gave is we have an oil change that happens every 6 months, but we want to spread out that oil change cost over equally over each monthly budget, right? So that's the idea that we're doing here. We're going to estimate what all these actual costs are. So I'm going to, at the very beginning of the year, estimated manufacturing overhead in dollars, right? This is on January 1. I'm going to do this calculation. Estimated manufacturing overhead dollars. So what do we think? We're estimating what we think our total actual costs were. In this example, we think what are all of the indirect costs that are going to happen in my factory going to be, right? And then we put that over our estimated hours. Now, we got into this in class a little bit, but remember this right here is just your driver, right? What we're saying is the more hours this factory runs, the more estimated manufacturing overhead costs we're going to have, okay? In this class, this hours number will either be estimated direct labor hours or estimated machine hours, okay? So this will be either machine hours, or direct labor hours. Okay? Now, you guys have watched the software and hopefully been paying attention. You should be. So what does this give us? What is it called once we do this calculation? It's called the predetermined overhead rate. Okay? It's going to be some dollars per hour. Dollars per hour, okay? Let's assume, for purposes of this example, that our dollars per hour is $10 per hour. Okay? Just an assumption that we did this math from the estimates that they gave us, and we got that $10. Now, once we calculate this predetermined overhead rate, these estimated numbers can go out the window. We don't need to use them ever again. Okay? In all of these problems, you're going to be tempted to use these estimated numbers again. So what you need to do right at the beginning is just take your estimated numbers, the estimated manufacturing overhead over the driver, the hours, find your predetermined overhead rate, and then cross off the estimates. You don't need them anymore. Once you have this rate, you don't need your estimates, okay? So now what we do is we come back, and let's say let's say that we estimated this car would take 10 hours, and we estimated this car would take 9 hours, and we estimated that this car would take 10 hours, okay? But actually, so these are our estimated hours. Let me label this. Estimated hours. Now, let's put actual hours up here. Let's say this guy ended up taking 20 hours, this guy only took 5 hours, and this guy only took 7 hours. Okay? Do you think, if you were the manager here, would you want to allocate all of our overhead costs or spread out all of these estimated overhead costs, all the indirect costs, according to the estimated hours that you thought would take? Or at this point, you know your actual hours, so would you want to allocate them based on actual hours? So as a manager, you're going to want to, you know actual hours. You want to use actual once you have it, okay? So in this case, let's say this is car A, car B, and car C, okay? We're going to allocate based on actual hours. So the total actual hours that were done there, if we add all these up, it is 32. So I'm going to take this rate and I say, because all those cars took up 32 hours on my belt, then I'm going to take this $10 per hour, multiply it by the 32, and that will give me $3.20. Okay, why are we doing this? What is the steps here? Well, we took this predetermined overhead rate. So let's step back a little bit. This $3.20 then is going to be my applied amount, meaning I don't know all of my actual costs yet, right? But I need to apply those or assign some value of your indirect costs onto the current belt that's happening right now. So since I just calculated that, I'm going to take that $3.20, put it as applied, and debit it into WIP. Okay, this is applied manufacturing overhead. Okay? So how do we calculate this number? As a formula for you to remember, we took the predetermined overhead rate and we multiplied it by actual hours. Okay? Remember how I said you're going to be tempted to use these estimates later on? This is where students tend to make the most mistakes here, is they can figure out the predetermined overhead rate, but then when they multiply to find their applied number, they multiply it by their estimated hours, right? But this is, your applied number is where your estimates and your actual meet, okay? So your estimates are contained in this predetermined overhead rate. Remember, you took the estimate over the estimate to get there. Now you're going to multiply that by the actual hours that are happening on your belt, because that's going to allocate them more appropriately. And that's going to give you how much you're going to put into, actually apply into this WIP account. Okay? So what we're saying is all three of these cars that are on the belt right now have been allocated or applied 320 of what we think our total manufacturing costs will be. Okay? So you have to remember the apply is this formula, and it goes as a credit into manufacturing overhead. Okay? Now, once we finish these goods, let's assume that there's no direct materials, direct labor costs, just for simplification of this problem. Okay? Once we finish this, we would take out the costs from WIP, because now they're moving into finished goods, and I'm going to put them into finished goods. Okay? Now we sell them. So I'm going to take them out of finished goods and record them into cost of goods sold, right? Oops. Let's do that again. $3.20. So now, on my income statement, I'm showing $320 of the cost of all the goods that I've sold this period. Okay? But, let's say we get to the very end of the year, and I finally know what my actual overhead cost number is, and let's say it's $300. Okay, so all of my actual bills came in, and I totaled them all up and put them into my manufacturing overhead, and they ended up being only $300. Now, how much did I actually send through? How much did I think it would be? Well, I sent through 320, remember? It went up into WIP, and then it finally ended up in cost of goods sold, right? If my actual bills were only 300 then, is my cost of goods sold number too high or too low? Pause it and think about it if you need to. Is your cost of goods sold number too high or too low compared to our actual bills? Well, it's too high, right, by $20. So in order to reduce cost of goods sold is a natural debit, right? So to reduce it, I need to credit it for $20, and that's going to bring our cost of goods sold down to 300, right? Now, if that's my journal entry, I just credited cost of goods sold for 20. What's my debit? Well, if you look here, we had a balance of 20 right here, meaning we've over applied. We've applied too much, right? This is over applied. So if we debit this account for 20, that's going to close this account out, and that's what we want. Okay, so we're going to debit manufacturing overhead. Okay, that will be your journal entry there. Now, this is to make the adjustment for over or under applied. Okay, this $20. Now, in this case, it's over applied, meaning we sent through too much, so we need to reduce COGS and then close out our manufacturing overhead. That's how I would suggest you think through it, because if you're sending it through and you think about whether COGS needs to be higher or lower, then you just do the opposite thing to manufacturing overhead. You have a check figure for yourself, meaning if this closes this account to 0, then you know you did it right. Okay? So let's say that instead of being over applied, our actual bills came in to be $280. Okay? So many of our actual bills came in to be. Well, actually, that's not what I want. Let's say our actual bills came in at $350. Okay? So my actual bills were $350, but I only sent through $320. So is my cost of goods sold too high or too low? It's too low compared to our actual bills, right? So to make it higher, to make it meet my actual bills, I need to add 30. Okay, the way you can figure that out is you say, look at the balance here. It's 30 here. And since there's a debit, it means it's been under applied, meaning we haven't applied enough, right, compared to our actual bills. So if it's under applied, we need to increase our cost of goods sold by 30, so debit it. And then we're going to credit our manufacturing overhead account for 30, which if we credit it for 30, that's going to bring us down to 0, and that's what we want. Okay? So depending on whether it's over or under applied, you'll always have cost of goods sold and manufacturing overhead in your over or under applied account, or journal entry rather, but it's just going to be switched depending on whether it's over or under applied, okay? If it's under applied, we're going to have to debit COGS and credit manufacturing overhead. If it's over applied, it's going to be the other way around. Okay? So what I would suggest is going through the practice exam problems on these. Take some time, go to the accounting lab. They will walk you through this and get this down before we move on, because you don't want to be swamped in all this other stuff before we get into budgets and things like that. Okay? Good luck, and let me know if you have questions.